Most investors believe they are doing everything right. They buy low-cost ETFs. They diversify. They hold for decades. They ignore noise and stay disciplined. On paper, it looks perfect. But here is the uncomfortable truth. One of the most common ETF mistakes does not show up in performance charts, backtests, or annual statements. It only appears when real life collides with markets. And when it does, it can quietly erase hundreds of thousands of dollars from a retirement that looked secure. Imagine two investors. Same age, same income, same ETF portfolio, same discipline. 20 years later, one retires early, travels freely, and never worries about money again. The other keeps working, stressed, confused, and angry at the market. The difference was not intelligence, timing, or luck. It was a structural mistake that felt safe, looked responsible, and went unquestioned for decades. This video is not about picking better ETFs. It is about understanding how ETFs behave when you actually need the money. Most people never think about that part. Here is the setup almost everyone follows. You buy a broad market ETF. Low fees. Strong reputation. You add a bond ETF for safety. You rebalance occasionally. Your net worth chart trends upward. Everything looks fine. Then retirement arrives, or a major life event forces withdrawals, and suddenly the math stops working the way you expected. Not because the ETFs failed, but because of how they were used. The mistake is confusing diversification with risk control. Holding multiple ETFs does not automatically reduce danger. What matters is how those ETFs behave under stress, especially during the years when you are pulling money out. Correlation during bad periods decides outcomes, not labels like stock or bond. Let's look at how this plays out in the real world. Picture a classic portfolio. 60% total stock market ETF. 40% broad bond market ETF. It looks conservative. It looks professional. It even mirrors many target date funds. For years, everything feels stable. Then a bad sequence hits. Stocks fall sharply. Bonds also drop because interest rates rise or inflation spikes. This happens more often than investors like to admit. Now withdrawals begin. Maybe retirement starts. Maybe a business slows. Maybe medical expenses appear. Cash is needed. So shares are sold at depressed prices. Losses are locked in across both sides of the portfolio. The ETFs themselves were not bad. The structure was. This is where the damage becomes permanent. Losses early in retirement shrink future compounding. Even if markets recover later, the sold shares are gone. The portfolio never fully catches up. On a spreadsheet, this can easily mean the difference between withdrawing $40,000 a year and $70,000 a year for life. That gap is not theoretical. It is lived. This is why some investors with smaller portfolios retire better than people with much larger ones. It is not about returns. It is about structure. Broad ETFs are excellent accumulation tools. They are not withdrawal tools by default. They are designed to grow efficiently over time, not to protect you from sequence risk. When investors ignore this, they mistake volatility smoothing for safety. They assume bonds always stabilize portfolios. Sometimes they do. Sometimes they absolutely do not. The real issue is not which ETF you chose. It is that you treated all your ETFs like one bucket instead of separate machines with different jobs. Stocks are for long-term growth. Bonds, in a well-designed plan, are not there to boost returns. They are there to buy you time. Time is the real currency. The investor who survives downturns is the one who does not have to sell growth assets when prices are down. The mistake is holding bond ETFs without defining their purpose. If your bond ETF drops at the same time stocks drop, it has failed at its only important job. Wealthy investors understand this difference. They do not ask what percentage is in bonds. They ask how many years of expenses are protected. They separate growth from survival. They design ETF portfolios around cash flow, not allocation charts. Imagine two retirees with identical ETF balances. One has a buffer that covers 5 years of spending in stable assets. The other owns a blended stock bond portfolio. When a crash hits, the first investor does nothing. They live off the buffer and let stocks recover. The second investor is forced to sell. Same ETFs. Completely different outcome. The market treated both the same. Structure decided who survived. Another layer of this mistake shows up in taxes. Many investors hold the same ETFs across taxable accounts, traditional retirement accounts, and Roth accounts without thinking about withdrawal order. Selling the wrong ETF from the wrong account at the wrong time compounds the damage. Taxes accelerate losses. Required distributions force selling. What looked efficient on paper becomes fragile in reality. The solution is not complexity. It is clarity. Every ETF in your portfolio should have a job description. Growth ETFs are never touched during downturns. Stability assets exist solely to fund life when markets misbehave. Tax-free space is reserved for the highest growth. Taxable space is managed for flexibility. This is how the same ETFs multiply wealth instead of draining it. Here is a simple rule that reveals everything. If you cannot explain exactly when and why you would sell each ETF you own, you do not have a plan. You have a hope. Hope feels calm in good markets. It collapses under pressure. The investors who avoid this mistake are not smarter. They are more honest about behavior. They assume fear will show up. They assume bad timing will happen. They design ETF strategies that work even when emotions are loud. This is why this ETF mistake is so dangerous. It does not show up early. It waits until you are most vulnerable. And by then, fixing it is often impossible. So before you buy another ETF, ask yourself one question. When the market drops 30% and life demands cash, which asset pays the bill? Answer it now, before stress decides for you.